Howdy guys, Jimmy Song here. Welcome to another episode of Bitcoin Tech Talk Q&A. And this is the show where I go through a variety of stories from the past week. It's based on the newsletter that I sent every Monday morning. It is available in the show notes below, but it is jimmysong.substack.com. Anyway, a lot of stories this week. Let's take a look at some of them. This is again, you can go to jimmysong.substack.com to go and read all about it and get it delivered to your mailbox. It's in the show notes as well. Anyway, yeah, lot of stories this week. But before I do that, let's take a look at some of the stuff I want to show. A couple of my books are available on Amazon if you are trapped inside, which most of you are, I think. But yeah, the Little Bitcoin book is available on Amazon for $11.99. Also available on the Kindle if you don't want them to deliver anything to you. Programming Bitcoin is available on Amazon for $42.55. Great book if you want to learn all about Bitcoin from a technical perspective. All right, so let's go to the actual newsletter. This one's titled State Chains, a Semi-Trusted Layer 2 Protocol. So a lot of things in Bitcoin surprised me, right? Like I think SegWit definitely surprised me because of what it was able to do without like breaking backwards compatibility, essentially increased block size, which I didn't think was actually possible. The other thing that really surprised me, I think, was Lightning, the ability to do trustless transactions without any without needing to put the transaction in the block. And both of those things are now in full swing. But those were two of the things that really surprised me because it's an innovation in a direction that I didn't expect, and that those are the things that made them very surprising because it's not something that I thought was possible. And in many ways, Bitcoin was the same way. It's something that a lot of people didn't think was possible, but actually ended up being possible, right? Like nobody thought that there was a way to do decentralized digital money until Satoshi released the client and so on. Anyway, state chains, I think, falls into the same category. And the essential idea of state chains is that you have sort of like a semi-trusted third party that enforces a UTXO transfer, but isn't able to just release a bunch of can't steal the money from you because it's like one of two. And it's done in such a way that the last person to have it can always just sort of go on chain and take the money, which makes it secure. But the nice thing about state chains is that it can be directed towards a Lightning channel. And that means that essentially opening a Lightning channel now no longer requires any sort of on-chain transaction. And that makes Lightning essentially infinitely scalable as long as a lot of UTXOs are on state chains. And that's what makes this really, really interesting is that there's no need for any sort of on-chain transaction if you transfer them. Now, there are certain limitations to state chains, which we'll get to, but essentially, they're kind of like dollar bills or something like that. If you pay for something with $20, you have to get change back unless it happens to cost exactly $20. And that's what state chains essentially ends up being like. The big thing and the reason I bring up state chains this week is because there's somebody that started working on it. And this is a message from Tom Trevethan from Commerce Block. And basically, they want to implement state chains. The only thing is that there's a couple of things in state chains that require modifications to Bitcoin. So sig hash no input is one, and I think the other one is using the protocol enable the change of ownership of an individual position in an octet discrete lock contract without an on-chain transaction and without needing the cooperation of a counterparty. The protocol, as outlined by Rubin, requires features not currently available in Bitcoin, like SIG-hash no input, and it is uncertain when or even if this will be added. So we are looking at variants. So, they're basically asking the mailing list about ways to get around this particular lack of SIG-hash no input and other things. So that's why I bring it up. But we're going to do a long read of the sort of more layman's explanation of what state chains are, which was written by Rubin over the summer. But it's totally well worth reading and just understanding some of the possibilities that are in these level 2 or layer 2 stuff. All right, so Bitcoin. BitMEX has come out with an article on who funds Bitcoin development. And I think Bitcoin Magazine had something similar, but this one is a little bit more comprehensive, and I like it better for that reason. But here are the developers that are being funded, the number, and so on: Blockstream, Lightning Labs, Square Crypto, MIT DCI, Chaincode, Purse, DG Labs, AsyncQ, Bitfinex, Xapo, Hardcore Fund, Private Donors, BitMEX. Oh, I guess I shouldn't have listed Bitfinex there. I didn't see that there for some reason. Here are the top 33 core contributors and where they come from, and it's these people. Anyway, so here, let me go edit this because I don't want anybody to get the wrong idea, because I did list Bitfinex as one of the ones that were not funding, but they clearly are, and I made a mistake, so I am going to correct it right now. So that's what I am doing. All right, so it's now been updated. So basically, BitMEX has come out with an article about that, and Chaincode Labs, Blockstream, Lightning Labs, Square, MIT DCI, Xapo, Digital Garage. They're all sort of contributing back to the space. Notably absent from this list are Coinbase, Blockchain.info, Circle, and Binance. Now, Blockchain.info used to fund Siors Provus, but I think he's now being funded by BitMEX and OKCoin. So, in essence, these companies are kind of like bad actors, right? Like we know that they're making lots of money, or at least they've raised a lot of money. They could very easily fund the ecosystem to some degree, but they refuse to. And that's something that I wanted to point out, because if you're a customer of one of these, you should really think about not going with them anymore, right? Like, if they're not really contributing back to the ecosystem, then they're kind of being bad players or bad actors. They're just sort of leeching and not really giving. I mean, there's a place for that, but I mean, I would much rather be using one of these guys. Fees getting high. There's a nice open source tool called Mempool to estimate fees. So this something that I got alerted to recently, but this is a fantastic little open source project. And essentially, if you're wondering what fees to use, they give you a very good idea, and they have an insanely slick interface. So you can take a look at it here. So they tell you how many transactions are in the mempool, and right now it's enough to fill up about one block right now. Once it gets to another one, then it'll show another block and so on. But there isn't so you can see the second one just popped up. There's now enough transactions in the mempool to fill one and a tiny bit more. So every time a block is found, it goes into this, and you can see that the last 4 blocks weren't exactly full. The previous 4 blocks before that were. And you can also see that there's like a block explorer. This is, I think, V2 and so on. You can see graphs of how many transactions at what Satoshi per byte there were. The 1 megabyte thing is sort of like a line to know, okay, how many blocks worth are in the mempool at the moment. So it peaked at around, I think around 1:30 p.m. when it was about 5.75 or 6 megabytes or so. But then like 5 blocks were found in about 12 minutes. So that reduced it significantly. And then nothing was found for another 12 minutes. And then 5 blocks were found in the next 28 minutes, and that pretty much cleared the mempool. So you can get a very good idea of what's going on, and you can even put it on like a TV screen, and you can get a visual of like what the fee market is like. And they also have an API, which is very useful. I think they have documentation here on like what the recommended fee is and so on. Where is the API? I do know that they do have an API. Might be on the contributors, maybe. Yeah, so fee API. So if you copy this link, this is more for programs. If you want to know what the recommended is, fastest fee is 20 Satoshi per byte. Half hour fee is 2, and hour fee is 2. I think that's actually kind of conservative. You could probably be a little more aggressive and do like 1 and be fine. And I would love to see the algorithm around this. But the nice thing is this is available on Docker. You can just run it next to your Bitcoin D node, and it can get all of the data from the Bitcoin D node, including the mempool and so on. It keeps its own database of fees and so on, and gives you an idea of what you should bid in order to get into a block. And very, very useful tool. Hopefully, more companies and users and services start incorporating stuff like this. And the fact that you can run it on your own is gigantic. And if you run electors, you're at least for V2, you're supposed to be able to have a full built-in block explorer as a result, in which case now you don't have to use blockchain.info, for example. You can just use your own node. I've made my own. I have it pointing via dynamic DNS and so on. So really cool little tool. And I hope these guys continue to build stuff like this, because this is genuinely useful, right? Like, I don't want to have to trust somebody else to know what the fees are. I don't want to do any API calls and compromise my privacy. I want to do all of this on my own, and that's very useful. All right, so really slick interface, and you can build your own backend and so on. All right, so here is another article. This one is from Unchained Capital's Parker Lewis. This is part of his series, Gradually Then Suddenly. Absolutely fantastic series. If you haven't read all of them, it's totally worth reading, because it gives a really good overview of what's going on and Bitcoin's value proposition in all of them. This one in particular goes to Parker's expertise, which is macroeconomics and the Fed and how they work and things like that. And he points out exactly what's going on with the amount of money on the Fed balance sheet right now. So basically, the Fed had a lot of money on its balance sheet as a result of quantitative easing after 2008. And then they gradually basically deleveraged a lot of stuff, starting to unwind. And they didn't even unwind that much. Look at the level. It's like 4.5 trillion. They unwound to about 3.8 trillion. So it wasn't even that much of their stuff. It's not even like 20%. But then repo market broke, so they started having to or sort of inject more liquidity into the market. And then right now it's above what it was even before then. So it's stuff like this that he gives insight into and what's going on. The unlimited QE program, the difference with Bitcoin and all of the different things. This thing's hilarious. Janet Yellen doesn't expect a new financial crisis in our lifetime, June of 2017. Yellen warns of another potential financial crisis, December 2018. There's a single image that explains why economists don't know what the hell they're doing. This is it. Anyway, really well thought out article. Encourage you to read into exactly how Bitcoin is different and why the current situation is beneficial for Bitcoin, basically. All right, Breeze has updated their Lightning app to be more merchant friendly. So essentially, Breeze is a Lightning app on your phone. But one of the things that they're doing now is that they have a point of sale app that makes Lightning receiving Lightning payments really easy. And I have to say, like I've used Breeze a lot during my like whenever I sign books for people and stuff like that. If they're buying the book from me, I'll often take it in Lightning because they want to try it out. The thing that gets frustrating as a merchant is that whatever your inbound capacity is, that's how much you can receive, and then you have to do some sort of like a submarine swap out before you can get that channel capacity back again. So having a different sort of UX for merchants makes all the sense in the world, and that's what they're doing with this. Now I haven't tried any of this, but the fact that they're moving in this direction tells me that the Lightning Network is definitely moving in a more mature direction, because previously every node was more or less the same. But what we're realizing is that there are some people that are spending, and there are other people that are merchants that are constantly collecting, and you need to be able to cater to those people to make sure that the people that are on the receiving end have enough liquidity to get out of the Lightning channel and be able to do other things with it. So I applaud this, and I hope that more Lightning companies go into this sort of like specialization and listening to their users and figuring out exactly what's important to people like that and so on. All right, so that was Breeze. Jameson Lopp has a nice blog post. So he wrote a nice blog post as a way to replace Earn.com. So basically, he I guess had an account on Earn.com and charged people like $100 to contact him. Now he's doing it like using BTC Pay and Lightning and so on. So you can do this with BTC Pay, Lightning, and allow people to pay you in order to read their message and reply or something like that. And that's fantastic. I think like Earn.com was centralized, and the fact that this is a decentralized version of that is something that like kind of like how BTC Pay replaced BitPay. Hopefully this will replace Earn.com, although Earn.com wasn't really that popular to begin with, but it's a good idea. All right, economics, engineering, etc. This is another article on the stock to flow influences on Bitcoin price, and this is from Nick, and it's trying to invalidate it, but the stock to flow model, but it finds out it can't, and essentially this is a lot of sort of like quant math, basically, that you have to learn in order to be able to make a lot of sense of this stuff. But the conclusion is interesting. Basically, it is co-integrated, and let's go back to the abstract so I can just read from it directly. All right, there we go. There's a method. Thus, while many tests have been able to be shown to be incorrect or have serious errors, we haven't been able to reject the hypothesis that the stock to flow does not have an important non-spurious influence on the US dollar price of Bitcoin. So it's basically saying stock to flow and price have some co-integration, which is really remarkable if you think about it, because the stock to flow model is telling us something about like it was coded in from the beginning, so in 2009. Yet the dollar seems to be following it. So the chain of causality is very clear. The dollar is following the stock to flow model and not the other way around, because it was coded back in 2009. So what's exactly going on here? And that's like a question that I think any decent economist should be thinking about is, okay, why is there co-integration, and what's going on? There are a lot of people that are skeptical about it, especially because it was coded into the protocol in 2009. So why should it be true? Isn't it like most economic things? There's a sort of one thing influences the other, and the other thing influences it back, and there's sort of like a feedback mechanism. There's no feedback mechanism in this. So what's going on? Well, I mean, other than the difficulty adjustment. So figuring that out would be an interesting exercise as well. All right. The U.S. House of Representatives had previously had a bill in the House which had an interesting provision in it, the digital dollar. And, that it did get removed in the final bill. But this was the bill from, I think, Maxine Walters' office. But here's where, the definition of a digital dollar wallet is. Shall mean a digital wallet or account maintained by the Federal Reserve Bank on behalf of any person that represents holdings in an electronic device or service that is used to store digital dollars that may be tied to a digital or physical identity. So I looked into it, and essentially it's basically a way to guarantee a bank account. A bank account for certain people. A lot of people in the U.S. don't have a bank account, so they use like sort of cryptocurrency terms, but it wasn't that at all. It was just everyone's guaranteed a bank account, and they made it so that these digital wallets may not be subject to any account fees, minimum balances, or maximum balances. So it didn't make it in this time, but these things have a habit of showing up in other bills, and I wouldn't be surprised at all if it comes through in some other bill in the future. So keep an eye out. But yeah, it has nothing to do with like a US dollar digital cryptocurrency. It would just be the like basically everyone in the US would have an entitlement, which is a bank account with the Fed. All right, Cointelegraph has an in-depth analysis on Bitcoin transactions in 2020. Now, I don't usually quote things from Cointelegraph, but it's a good article because it's actually doing original research. So it looks at the Bitcoin transaction data. It says, for example, the transaction peaked at 490,000 a day in December of 2017. Transaction count reached the low of approximately 132,000 per day at the beginning of August 2017, so about 8 months later. Then peaked at around 500,000 transactions in mid-December. So this was between August and December, not 8 months later. It was 4 months before. Daily transaction value at the end of February 2020 was well over $3 billion. And, there's transfer volume, amounts, total, address data, number of Bitcoin addresses, number of Bitcoin total addresses, and so on. It does seem that more people own one Bitcoin or more. And this is total Bitcoin addresses has been kind of going exponential. The number of Bitcoin addresses has been going up kind of linearly, and the number of Bitcoin addresses with 1,000 Bitcoin or more is more logarithmic or something like that. So it's interesting. The UTXO age distribution seems like it looks like it's allow me to So this is from Unchained Capital. Basically, price appreciation peaks are always followed by major sell-offs. The number of addresses holding Bitcoins for less than 1 year during these periods substantially increase. So basically, more people sell during the peaks. Bitcoin block size, block weight, it peaked right around there. Now it's like a little bit less. So we're not even filling up the space that we have, just so you know. Number of Bitcoin transactions on SegWit, and this might be one of the reasons. About half or more has been SegWit, like starting, I guess, around July of 2019, about 8 or 9 months ago. Block height continues to release, to increase, and we can see what's going on there. And some interesting conclusions. Transactions are not only increasing, but the amounts being transferred are as well. The impact on price appreciation has been quite positive during the past 10 years. Number of total addresses is growing as well as the amounts. held by both dumb and smart money. A great deal of Bitcoin is locked away by holders who only sell near peaks. Blocks are getting full, and new techniques are allowing for more transactions to be added per block. So interesting stuff from an economic standpoint. All right, and this last one is from the Open Money Initiative, and basically they were looking at sort of Bitcoin volumes in South America, and it turns out that they are all pretty much correlated with what's going on in Venezuela, which is interesting because it turns out that transfers in and out of Venezuela tend to be the driver of a lot of the Bitcoin activity. All right, let's see. I did 2 shows. The last week's show was on the BTC sell-off, and I also did the second half of the Satoshi white paper. This will be my long read. Let's go through my Twitter and talk about some of the tweets, because I got some interesting responses to some of the tweets. And, since I'm stuck at home, I'm tweeting a little bit more than usual. All right, let's take a look. Fed, Martingale's strategy of doubling down every crisis. Bitcoin, monetary policy unchanged since 2009. Now, the Martingale strategy is sort of like a gambler strategy. Essentially, what you do is you go to a roulette table and you bet on red and double. Bet on red. If you win, that's fine. If you lose, if it comes up black or green, then you double the amount and put it on red. And basically, if you win, that's fine. If you lose, then you double it again. If you win, that's fine. If you lose, you double it again, and so on until you win. Now, it helps because like the probability of busting is fairly low at any local minimum, but the expected value is still negative. So you end up losing. And that's essentially what the Fed is doing. Every crisis, they seem to be doubling down. So 2008, they did, quantitative easing. 2000, they lowered interest rates tremendously. 92, they also lowered interest rates. 87, like you can go back to every sort of like fiscal crisis, and every single time they made it so that it would. They doubled down on the monetary expansion and basically expanded their way out of whatever recession, depression, or panic, or whatever you want. And that's been their strategy, and that's what I was pointing out. Perception of hoarding is causing retailers to limit purchases on stuff like toilet paper and rice. This in turn causes even more panic buying. Imagine what happens when the perception of hoarding Bitcoin starts. So something I've noticed is that I believe that a lot of the panic around toilet paper right now is because of the perception of the panic around toilet paper. It quickly becomes reality until there's a glut of the supply. So there's sort of like a demand for it that a lot of people are perceiving there to be, and therefore they go out and hoard. Now, like the production of toilet paper will adjust, and I'm sure a lot of these places are going to have a glut of them by the summer. But for others, if you think about Bitcoin, there's no way to produce more of it. So think about what happens to price when you have, sort of like this perception of scarcity around Bitcoin that I think will happen pretty soon. So that's something I wanted to point out. Any good recommendations for courses to take online? Really good, really good suggestions here. I'll probably take a look at some of them, but good things to do while you're in quarantine, right? All right, the big players in the crypto industry think they've won already and believe themselves to be kingmakers. It is still early, and many of them, especially those that are undermining Bitcoin by promoting alts, are going to get their lunch eaten. Think Mt. Gox, BTCE, and Vercurex. Now, those are all now defunct exchanges, but one of the things about a lot of these exchanges is they think they're immune or that they've already won, it's like sort of like. Don't celebrate too early kind of thing, because the market's always changing. And this is the advantage that startups have, is that they are more nimble. So like it took Coinbase forever to do batch transactions. I don't think I still don't think they support SegWit. Neither does blockchain.info. This is where open source tools and other companies are going to completely eat their lunch, and that's going to be very interesting coming very soon. Just a warning to all of those companies that aren't supporting the core dev community or funding any developers or anything like that. I mean, that's who I'm basically aiming this at. I already told you about the digital dollar wallet. What are your predictions on industries that will change the most as a result of this crisis? Some interesting answers. Money, tourism and restaurants, retail and commercial real estate. Lots of different ones. I don't know why more replies aren't showing, but Twitter API can be weird like that. So this is the FDIC saying, don't take your money out. But, if they're saying don't take your money out, you're going to instantly think, should I be worried? So I think it has sort of the opposite of the intended effect. All right, so this was after they announced that it was going to be $6 trillion of money printing. So that is the M2 money supply in 2004, 16 years ago. That was all of the M2 money supply in 2004, $6 trillion. Now they're pumping that all into the economy. GDP of the U.S. in 1990, that was the entire gross domestic product, which is insane. Down payment to buy all the real estate in the U.S. I think if you aggregate all of the real estate in the U.S., it comes out to something like $30 trillion. So down payment would be 20%. $6 trillion is enough to do the down payment on all of those, which is insane. Enough to buy 68.9% of all gold in the world at spot. And 1.6 years of tax revenue for the U.S., which is insane, right? Like, I can't believe it's like they're collecting taxes when they're able to print $6 trillion. It's but, I guess they have to keep up appearances. One metric where the USD will soon pass BTC, divisibility. So M2 money supply, after about $6 trillion more of money printing, which I expect will happen, it'll be $21.5 trillion in M2, which is 2.15 quadrillion cents. Bitcoin has a money supply of 21 million Bitcoin, and one Bitcoin is 100 million Satoshi. Multiplies those together, it's 2.1 quadrillion Satoshi. So the US dollar will have better divisibility, at least versus Bitcoin on chain. At least on the Lightning Network, you can go millisatoshi. So it beats the divisibility there. How much longer until we can live long, normal lives again? It seems that most people think it's going to be a little over, or at least the median's a little over 3 months. So let's call it like 3.5, 4 months, something like that. That's, looking much more likely. It's definitely not 3 weeks because I think we're shut down until April 30th, at least in the US. You can see just how fragile our system is during this crisis. More importantly, you can see who has been carrying the brunt of the fragility. People and small businesses that are close to bankruptcy. So many of these, people and, businesses, they're very fragile as a result of the fiat system. They don't have any money saved up to be able to do a rainy day fund or anything like that. And, they're all living paycheck to paycheck, basically. People, small businesses, even banks to some degree. The difference is that the big banks get bailed out each time. And that's a big difference. All right, opinions, situations, expectations, and norms will change very rapidly in the next few months. I'm talking, of course, about Bitcoin. It's also true of, just society in general. Because of what's going on. Daily survey. Which of the following from the crisis will have the biggest long-term impact? Deaths from the virus, economic intervention, government overreach, or other. Looks like people think it's economic intervention. Other surveys during the week actually show similar things. Stimulus bill is essentially a payday loan to the American people, except we're not getting as much value as a payday loan would. Why do I get the feeling quadrillion will be entering the lexicon in the next 5 to 10 years? Obviously, because I think people are going to start talking quadrillions pretty soon, because you need to keep sustaining this. Peter Schiff was bragging that Bitcoin was going down while every other asset went up. Of course, at the time, Bitcoin was down like 0.1%, and Gold was up 0.2%, and then like 4 hours later, it was the opposite. So his tweet didn't even wasn't true for even like 4 hours. But I mean, this a guy that learned about Bitcoin in 2011, refused to buy, and that's kind of what happens when you have Bitcoin derangement syndrome. You will crow about anything. Information is messy. Reported numbers do not measure the same thing, have errors, and are often manipulated. In other words, they're unreliable. Unfortunately, anxious people want certainty and start to trust those numbers, learn to live with some uncertainty instead. The thing about any sort of reporting is that if they're consistent, you can at least take the derivative and glean some information about it, but there's no guarantee of that either. The change between reports can be influenced by all sorts of things. Politicians that don't want culpability, or doctors that don't want culpability, and there's all sorts of fudge factors into these things. So usually the numbers reflect whatever the people that are showing the report want them to reflect. So it's not really that reliable. And I see people all the time, but look at the growth here in this place and this place, and aren't these things meaning something? And it's like, well, it's only as good as the source data, and as far as I can tell, the source data kind of sucks, and they measure different things, and they're from all sorts of different sources, and they aggregate differently, and they're counting different things. So especially when it comes to statistics, if it's only the conclusions are only as reliable as the data that they're based on, and the data just isn't that reliable right now, and that's the big thing. What habits have you picked up during your confinement? It looks like a lot of people saying like laziness or something like that. A lot of people saying programming, something like that. So good on you if you're picking up some good habits. Bankrupt businesses mean that banks will lose money, so government will bail out the banks by lengthening the time that for those businesses to die. That way, the banks can package those loans and sell them before they actually die. Banks win, businesses lose, we lose. And this is how banking has survived for so long. They've been making bad loans for a long time, guys. I mean, even in the 80s, you can think of like savings and loan scandal and stuff like that. They've been making bad loans, but they keep just getting bailed out over and over again. That's why they keep surviving, and they continue to make bad loans. But usually the way it's done is the central bank will provide liquidity, which is another way of saying they won't let people sell, or they'll prop it up until the bank can get rid of it, and then at that point, they don't lose money. All right. Getting us into 6 trillion more debt doesn't matter. Then why are we not getting 350 trillion more in debt so we can give a check of $1 million to every person in the country? This is from a House of Representatives person. And this is kind of true, right? Why aren't we printing even more money? Why do we pay taxes at all? What's going on? And this is a question that a lot of people are asking. These are just insane sums. And if you divide like 6 trillion by 300 million, that's like, 20,000, 300 million. Yeah, it's 20,000 per person or something like that. I mean, if you just gave that to everybody instead of trying to prop up banks and stuff like that, we'd all at least, basically be not paying taxes or getting the taxes right back, something like that. Fed prints money. Other central banks have to print money or not be able to export to the U.S. Prices in those countries go up. Consumers demand dollars because of the liquidity. Dollar demand keeps U.S. inflation down, accelerates other countries' inflation. TLDR, U.S. exports its inflation. And this is something that I've talked about in the past on the show, but basically the U.S. exports its inflation. Whenever it inflates, the rest of the world has to inflate in order to keep up. Otherwise, they won't be, dollar is the unit of settlement pretty much all through the world, international settlement. So if you don't keep a peg to the dollar, then your goods get really expensive and you start losing money. And this is what I tried to explain in this week. Unfortunately, it didn't get many likes, so I don't think I explained it that well. All right, monetary expansion inflation has historically been a violation of trust. Monetary contraction deflation has been how these violations correct. The state continues violating our trust by doubling down at every contraction. That's a real exponential. And the number, the amount of U.S. dollars in existence keeps doubling roughly like every 12 years, 10 to 12 years or so. That's the real exponential. That's something that we really need to worry about, because at some point it gets to insane sums very, very quickly. So I mean, this is why I expect quadrillions to enter the lexicon fairly soon. All right, so this was my Sunday survey with 3 parts. How many people do you know personally that have been hospitalized, that were tested positive but not been hospitalized, and tested for the virus at all? Looks like a vast majority of people don't know a single person that's even been tested. They might be showing symptoms or something like that, whether this is due to the lack of testing. I mean, it's just so crazy, right? Like that, like if it really is a pandemic, shouldn't the numbers be a little more or something like that? It's kind of crazy, but I guess that's what isolation does. Central banking fiat systems require way more people to distribute, invest capital than otherwise. Each person that could be building ends up investing instead. How many iBankers, VCs, hedge fund managers would better serve society as entrepreneurs? And this is something that I've come to realize as I've studied Austrian economics, is that there's so much more new money being printed, and that new money needs to be distributed somewhere. And oftentimes, they go to banks or investment banks or some hedge funds or VC firms. They end up in those places where the money has to get invested. And it's all new money that has to get invested towards something. And the thing about that is that requires an enormous amount of labor. Think about how many VCs exist and hedge funders exist and iBankers exist. These are all people that are trying to allocate capital. And all of that effort could instead be going towards entrepreneurism. And in fact, like a lot of VCs are actually successful entrepreneurs that transition into the investing game or capital allocation game essentially. And that's something that occurred to me, that like if all those people weren't distributing capital, if it was a sound money system, there wouldn't be as many people being needed to go and invest. Instead, they can go and build. And anyone that's investing in startups knows is that there's a real dearth of investable companies compared to the money that's available, and almost anything can get funded if it gets even a modicum of interest. Another month of lockdown looking pretty likely at this point. My goals: add 10 pounds to my bench, write a mini script parser, finish 2 online courses, and start going through 2 math textbooks. What are yours? So something to think about. There's probably at least another month to go. So, just think about what it is that you want to do. Somebody asked me about the books, so let me go and get them real quick. All right, so they are these 2 books. This is, let me just show them. So this is an illustrated theory of numbers, really good number theory book from what I've gone through about half of it. And this one is elliptic curves, number theory and cryptography. Essentially, I was recommended this book by a professor. I was a math major, so I can sort of understand what's going on in there. So, I'm going to have to read through it, and I want to start on it at least on this one. The other one, I want to at least make a little bit of progress. I love problem sets. Like this was like something that I loved doing back when I was a math major in college. So that's something that I'm looking forward to. All right. How many people do you know personally that have been laid off from their jobs this month? Majority know at least one person. So this tells me that the economic devastation is going to be way more, right? Like just on like at the ground level. Not many people know anyone that's even been tested. Most people know at least one person that's been laid off. So like economic impact, it would be kind of an interesting question. Like, would you rather be hospitalized or lose your job? I mean, it's kind of a terrible choice, and I'm not sure they're really even comparable. But I mean, it's possible that people would rather have a job and get sick and maybe recover versus something else. I don't know. It's hard to say. At this rate, you're going to have to spend $1,200 the government gives you to buy the mask that the government will force you to wear. Banks, big businesses, on the other hand, are getting real bailouts. Bitcoin fixes this. So yeah, I mean, basically they're going to give us $1,200 each, and we're going to have to spend it on the masks that they're going to make us buy. So, I mean, this is this is what's happening. Like they make it look like you're getting something. Really, you're at best breaking even, probably losing a lot of money due to the giant inflation that's happening. Big banks and all these businesses like Carnival Cruise Lines or whatever, they're all gonna get bailed out. All right, I guess Joe believes in the labor theory of value, and this was based on Joe's tweet about, like, are you more impressed with the person that acquired gold when you couldn't get any, or somebody that logged into Coinbase? Well, I'm more impressed with whoever made the right decision, and this is the false equivalent, like this is the Marxist labor theory of value, which is kind of ridiculous. All right, let's take a look at state chains. So this will be our long read. Non-custodial off-chain Bitcoin transfer. This article introduces state chains, a novel layer 2 scaling protocol for Bitcoin with some unique features. This is from Ruben Thompson, core dev out of Korea. We'll go through its strengths and weaknesses, look at how it integrates with the Lightning Network, and discuss the privacy implications of combining with blind signatures. I first unveiled my concept of state chains by presenting it as Scaling Bitcoin in Tokyo. That's a couple of years ago. Since it was a technical conference, my presentation was not focused on a general audience. As a result, it has largely gone under the radar, which is a shame because it's a unique layer 2 protocol with useful features that can strengthen the Bitcoin ecosystem. Hopefully, this article can convince you of its merits. Note that this article is high level and won't have all the technical details. If you want those, please refer to the talk, paper, and mailing list posts. State chains are a layer 2 protocol, meaning it can enable the transfer of value without burdening the Bitcoin blockchain. This can help with scaling and save fees. Unlike Lightning, it is not trustless, but it maintains a high degree of censorship resistance, more so than federated sidechains, due to the fact that withdrawing on-chain is permissionless. Okay, so that's the big thing. You can withdraw on-chain permissionlessly. With something like federated sidechains, which is what Liquid is on, you need the permission of like 11 of those 15 entities to go back on chain. With state chains, it doesn't have that property. The basic idea behind state chains is that you lock up money between two parties in a 2 of 2 multisig, the state chain entity and the user. So this is your semi-trusted party, the state chain entity. When the user wants to transfer the money, the entire UTXO, they simply hand over their private key, which we call the transitory key, to the intended recipient. And that's basically it. There's a lot more complexity operating in the background to decrease the potential for cheating, but in a nutshell, this is the core concept, and as you will see later, it's deceptively powerful. So basically, you hand over the private key, and the way it's done, it makes it possible for the person that's receiving it to have a claim to that UTXO. In essence, the money is controlled by the state chain entity and all of the users who know the transitory key. The state chain entity could theoretically move the money in cooperation with any of the users, but simply promises to only cooperate with the last user that received the transitory key. One thing the state chain entity cannot do is move the money on their own. So the one security property that it has is that it needs cooperation with somebody previously in the chain in order to screw the last person over. So it's semi-trusted in the sense that you trust that they're not going to cooperate because the state chain entity has some reputation to uphold or something like that. They can't do something like an exit scam. It makes it very difficult, or they can, but it's only going to be after they find people to cooperate with, essentially. Let's take a look at the weaknesses. If the state chain entity goes offline, loses their key, or refuses to cooperate, is the money gone? No. Every time the money changes owner, an off-chain transaction is also generated. This allows the last recipient of the transitory key to redeem the coins on-chain without the assistance of the state chain entity. the state chain entity simply cannot hold your money hostage. So this is very important because in a normal 2 of 2 multisig, one of the parties can hold the other one hostage, right? Like if they refuse to sign, there's nothing you can do about it. You're forced to cooperate with them in some way. By doing it this way, basically the recipient, anytime you receive a private key, you also get a signed signature from the state chain that allows you to transfer those Bitcoins on chain to your own address. So that way, if they ever go offline or they go bankrupt or something like that, you can immediately put that on chain and now you have the Bitcoin. So there's always a fail safe essentially. Can the state chain entity still cheat by colluding with one of the previous users that know the transitory key? Yes, they can, but chances of this happening are minimized for the following reasons. We keep the state chain entity honest by making sure they disclose every signature they make via clever use of adapter signatures. Any attempt to cheat the state chain entity would immediately become apparent. So you need to know a little bit about adapter signatures, but basically adapter signatures essentially expose some information whenever you sign something. So by forcing the state chain to use adapter signatures, if they try to screw you, you'll know immediately. You'll know immediately because they'll reveal some information. The state chain entity isn't an actual single entity, but a federation, a group of members of which a majority has to agree in order to cheat. This security model is comparable to federated sign chains such as Liquid, but with the added benefit that users can withdraw without permission. So the idea here is that this is different than this is similar in security model to federated side chains, but at the same time you get the benefit of being able to withdraw without the permission of the federation. So you instead of a single state chain entity or trusted party, you can make it a multi-sig, and that makes it a lot easier. Every UTXO has a different transitory key and a different set of prior users. To steal all the coins, the state chain entity would have to find prior users that are willing to collude for every UTXO. In the unlikely event of a theft, it is therefore only likely that only a subset of the coins get stolen. So it's whoever they can find. So, like maybe older ones trade at a discount because they've gone through more people or something like that. But that would mitigate some of the risk. Are state chains custodial? Surprisingly, they are not. This is one of the distinguishing features of state chains, that if a court ordered the state chain entity to confiscate someone's coins, they simply wouldn't be able to comply since they only have one of the two keys. They can't freeze the assets either because the owner can always redeem the coins on chain without their help. There's also no risk of fractional reserve, forcing hard forks upon users or other issues that are commonly associated with custodial control. So basically, they can't lend this out at all, and basically, it's locked to a particular UTXO. One unique feature of state chains is that it operates at the level of the UTXO. This has some interesting consequences, and see here's some badnesses basically. UTXOs are transferred in full. If you lock up one BTC in a state chain, you have to transfer the full amount. But bigger UTXOs can always be traded for smaller ones. So you might need to make change, right? Like, so if you have a one BTC UTXO, you can trade, and somebody needs to pay you half. You can trade the one for a half that you have, and then you get paid you make a net of half. You can swap multiple same value UTXOs with users, which is equivalent to a coin join to increase privacy, particularly when done over Tor. So you could trade these UTXOs, and that ends up being kind of like a coin join, and the only entities that know about it are the state chain entity and yourself, and the members of the coin join. So that could be a decent anonymity set. It's hard to tell. Lightning channels can be opened on top of state chain UTXOs in order to enable smaller payments. So there are ways to get change back without using like basically your own state chain UTXO versus somebody else's. Betting Oracle protocols that require UTXO ownership can be performed efficiently. Non-fungible color coins on the Bitcoin blockchain can be transferred off-chain via state chains. User verification of payment scales better than sidechains because coin history is linear. So you need to verify the history of the exact coins that interest you. So it does scale better because you don't need to check as much stuff. The key insight here is that anything that requires creating one or more new Bitcoin UTXO can be done off-chain via state chains. It's also worth noting that state chains are chain agnostic, meaning it's possible for a state chain entity to manage UTXOs from different blockchains and allow users to trade between them. So you could do something like an atomic swap. As I recently argued on Twitter, Bitcoin has no choice but to scale via the second layer. It is therefore absolutely crucial that this kind of technology gets built. We need many different layers that make different trade-offs so that people can pick the layer that best suits their needs. Here's an admittedly oversimplified overview of where the state chains fill in. So you got Bitcoin, Lightning, state chain, side chains, custodial. So Bitcoin and Lightning are trustless, and state chains, side chains, and custodial are not trustless. Bitcoin and Lightning are censorship resistant, and so is state chains with an asterisk. But side chains and custodial, like it's possible for side chains as a whole could be shut down, and then no one would be able to get their money out. Custodial, like Coinbase, you definitely are not censorship resistant. But here are the downsides: expensive due to scaling limits. For Bitcoin, limited channel routing capacity, inbound liquidity is a big one. Can't easily split UTXOs, that's for state chains. Permissioned withdrawals, that kind of sucks. Single point of failure for custodial. In short, state chains are novel in the sense that they allow you to change UTXO ownership off-chain while preserving a large degree of censorship resistance due to the ability to withdraw on-chain. It is non-custodial, which naturally reduces risk and makes it easier for the state chain entity from a regulatory point of view. The end result is a unique layer 2 protocol with its own distinct strengths and weaknesses. In other words, this is brand new. This is a trade-off that we didn't think of before, and that's a very good thing. State chains and the Lightning Network. One particularly powerful feature, which I already alluded to but deserves further explanation, is the interoperability between state chains and the Lightning Network. In order to open a channel on the Lightning Network, you need to obtain a UTXO on the Bitcoin network and share its ownership with somebody via multisig. State chains provide the exact functionality. Any UTXO that exists on a state chain can be turned into a Lightning channel at any time. So that's really powerful. You could take a UTXO, turn it into a Lightning channel, and you could prove that it exists, basically. The beauty is that this is kept completely hidden from the state chain entity. All the entity sees is that the entire UTXO got transferred, but they are entirely unaware that this is actually a 202 multisig Lightning channel. The two protocols are kept completely separate. The state chain entity doesn't need to be involved even when forced on-chain closure occurs. So you could do a Lightning channel creation off the state chain UTXO. By utilizing state chains, you get to open and close the channel off-chain at minimal costs. Is your channel too small? No problem. You can simply transfer your existing channel to a larger UTXO. This can be particularly powerful considering it's hard to know ahead of time how much capacity you will need in a channel. Now you can cheaply experiment, and once you have a stable channel, you can choose to effortlessly move the channel over to the base layer by exiting from the state chain. Another really potent consequence is that state chains enable you to onboard people onto the Lightning Network instantly. If you have money on a state chain, you can immediately send a portion of it to a friend by turning the state chain UTXO into a shared Lightning channel. And if your friend prefers to minimize their exposure to the state chain entity, you could directly move the channel on chain. So in other words, you can two advantages. You don't have to put anything on chain, and as a result of that, that means that you can open a Lightning channel right away. And that, theoretically at least, that's very powerful, especially if you want to try it for something instead of waiting 10 minutes or 20 minutes or however long it is to establish the channel. One more interesting feature that Anthony Townsend, Lalu Asun token alerted me to is that when you open a Lightning channel factory via a state chain, adding or removing people from the factory can occur without on-chain friction, making it far more flexible. So you can add more people into Lightning network basically. So that's very, like, basically if you're a hub, then you can open more channels easier, and that's very powerful because then you get more liquidity on Lightning and so on. Enhance privacy with blind state chains. State chains, as described thus far, limit the control the state chain entity has over its users, but it does allow the entity to learn about a lot about every transaction. And most of this information gets transparently published for the world to see. Engaging in the state chain's equivalent of CoinJoin helps mitigate this to a large extent, but we can do even better. Blind signatures can make the state chain entity completely unaware of what they're signing. The transactions would become entirely unseen. It would literally not be able to tell whether the entity is facilitating the transfer of money or if they're signing something else. You're essentially blindly changing the signing rights over a private key without changing the key itself, which undoubtedly has use cases other than cryptocurrency. Not only would this increase the privacy of the system, but it would also really challenges. You know what? I haven't been on this. Not only would this increase the privacy of the system, but it also really challenges the legal definition of what it means to process a payment. All the state chain entity would do is blindly sign messages at the request of a chain of users. A user gets to request one signature and also appoints a new user that gets to request the next one. All requests and corresponding blind signatures are transparently published. For those who are familiar with the details in the paper, the key difference compared to regular state chains is that users are expected to unblind and verify the chain of signatures prior to accepting a payment, because the state chain entity can no longer ensure that what it's signing is correct. If one of the previous requested signatures in the history is incorrect, the recipient simply rejects the payment. Unblinding can be done by anyone who controls the transitory key. In a sense, blind state chains are a variant of Xiaomi and Cash, but it actually manages to move one step beyond it. Xiaomi and Cash makes it impossible for a server to know who is receiving the money, but if the server refuses you service, you essentially lose the asset. With blind state chains, the server doesn't even know whether it's transferring money. It doesn't know who is receiving it, particularly when combined with CoinJoin, and it cannot stop you from redeeming its value on chain on the Bitcoin blockchain. So really interesting stuff. Basically, you can have a blind state chain, basically a state chain entity that will just sign whatever based on certain rules. But there's more verification involved with each user, which might be better. But basically, it allows all these transfers that are sort of done with a lot of privacy. Finally, it is worth noting that State Chains Protocol is the culmination of a bunch of technologies by many developers. As the author, my contribution was limited to creatively putting them together for the novel purposes of transferring UTXO ownership off-chain. Credit goes to the creators of sidechain, Schnorr signatures, adapter signatures, blind signatures, L2, Graftroot, and undoubtedly many more works that have inspired me, but I am failing to recall. So really, really cool stuff. And that's what we're looking at with respect to state chains. Hopefully that helps you understand what that is. It is coming. There's at least one company working on it. All right, let's see if there are any questions. Jimmy, any advice on how to get a job for people that read your book? I think I dedicated a chapter to that towards the end, so why don't you go read that? It's also open source, so you can go take a look at it. All right, I think that's about it. All right, so anyway, let me show my books once more. This is Little Bitcoin book. It's available on Amazon, English, Spanish, Portuguese, audiobook, Kindle, other ones coming soon. Programming Bitcoin, it's available on paperback. It's available on Kindle, lots of versions and so on. So, please take a look at them to support this channel and so on. So, that's about it for now. Fiat delenda est. This song is done.